You know, the worst thing you can do as being an investor is invest in a company that you truly believe in on their IPO date. Yeah, that happened to me. Let's take a look how we can automate our investments, how we can make it as easy as possible. And to make things super simple, you can actually create a portfolio of a single ETF that's gonna do everything for you. Hello everyone, my name is Alex. I hope you're doing well, I hope you're staying safe. Welcome to my channel where I talk about personal finance, investing, dividends, stocks, stock market, cryptocurrencies, and how to improve your financial life. And mine as well. Today we're going to be looking at different investment strategies, what the types of those out there, how they differ, how to pick the right one for you, what the one that I'm using and what I follow, and also how to automate your investments and make sure that you stick to it for as long as you need to. So investing shouldn't be hard, and everyone needs to be involved in investments as soon as possible so that you can gain from compounding interest for as long as possible. But also there are certain things you need to consider when you're building up your portfolio, right? Which is just the investment strategy you want to follow based on the goals you have in life, based where you are right now in your life, and what you want to achieve from your investments. There are a lot of challenges involved in running your own individual investment portfolio, and especially if you're investing into individual stocks. You need to pick right stocks, you need to pick the right time that you want to buy those stocks, you need to watch them, you need to sell them at the right time and all that. So these things become very complicated. And if you're picking the winners and doing all this correctly, this is great, but there's still some fees you're paying on top of that, which is what? It's your own time. So you want to make sure you're not wasting a lot of time doing all this rebalancing and configuring your own portfolio, right? Unless you're a financial nerd like I am, where I'm going through all the different stocks, researching them, and picking the right ones that I think will benefit my portfolio, and hopefully yours as well, then you probably should consider diversifying your portfolio with some ETFs that cover a bunch of different stocks. The other thing that is not easy as well is to decide what kind of portfolio you need in terms of the risk, which is basically what are your goals and when you actually plan to use your investments, if ever. You might be as close to start using your portfolio as soon as next year, or you might have 20 to 40 years ahead of you before you actually start using it. And that differs for everyone. Everyone has their own goals and or plans for their life. And to make things super simple, you can actually create a portfolio of a single ETF that's gonna do everything for you. These ETFs are also called one ticket, single ticker, asset allocation, or balanced portfolios. They aim to provide a peak efficiency and convenience to retail investors like you and I, with such cost or MER attached to it that it's still beneficial to hold this one ETF compared to holding individual stocks and holdings of these ETFs and then rebalance them yourself. One of the reasons why these ETFs are super popular, because they provide simplicity to your portfolio. You don't have to do anything, just contribute into a single ETF on a regular basis. And they also create based on the risk level and time that you have planned for your investments. These ETFs are actually one of the fastest growing funds on the ETF market. They've grown by $4.5 billion over the last 2 years. And now let's take a look at 3 different risk levels that we have: conservative, balanced, and growth, and what are the single ETF options we have there. The first one we're going to be taking a look is conservative portfolio, which is mostly applied to people who plan to start using their investments in the next year to up to 5 years period. For example, if you're nearing your retirement age, or you're saving for something like your tuition, or buying a house, or some other large purchase, and you're planning to use your investments for that, this is the type of portfolio that's going to fit you as well. Because these types of portfolio have a lot of allocation into bonds, so it's less risky on the short term. And it's as simple as that. So say you start investing in 2016 and your goal was to withdraw your money in 2020, right? For whatever reason, you're trying to buy a house or you were nearing your retirement age, right? And say you have your portfolio with a lot of allocation to stocks, and then boom, market crash 2020 happened and you lost half or even more of your portfolio. You don't want that to happen, right? With a lot of allocation into bonds, you're going to be less risky for these types of market situations. And there are 4 ETFs that I want to show you today for a conservative portfolio. The first one is Horizon's Conservative Tri-ETF Portfolio. The ticker symbol is HCON.TO. This ETF has a MER of 0.15%, so it's pretty cheap considering what we're getting in return. In terms of assets allocations, we have around 30% allocated into US equity, 7% into Canadian equity, and around 10% into international equity. So we're very well diversified in terms of the equity or stocks diversification. And the other 50% of the portfolio is allocated into fixed income, which is things like government bonds, gold, silver, etc. Things that are super low risk, but they also generate less returns. The next one we have here is iShares Core Conservative Balance ETF. The ticker symbol is XCNS.TO. So this one has a MER of 0.20%, so it's a little bit more than the previous one. And the asset allocation is also a little bit different. We have roughly 20% allocated to US equity, around 10% into Canadian equity, and around 13% into international equity. And the other part, around 53-54%, is allocated into fixed income. We are even less risky with this ETF. And there are two more which are very similar to each other. The first one is the Vanguard Conservative ETF Portfolio. The ticker symbol is VCNS.TO. And the other one is BMO Conservative ETF. The ticker symbol is ZCON.TO. Both of those have MER of 0.20%. So it's very similar to the iShares ETF, and their asset allocation is very similar as well. They have around 13% allocated to US equity, around 10% to Canadian equity, and around 12% to international equity. And the other chunk of the portfolio is allocated to fixed income, which is around 58%, which is a lot. So it means that this portfolio is even less risky and would fit better to portfolios with a shorter timeline. So that's conservative portfolio. It fits some people, but it doesn't fit some other people. That's why we have two more to go through. So the next one will be balanced portfolio. So the balanced ETFs, the balanced portfolios, are suited mostly for people, for investors who have medium-term time horizon. It means that they plan to start using their investments sometime in the next 5 to 12 years. So you still want to be low risk, right? But you don't want to miss out on the investment growing over time as well. And a good check here would be to see what happened to a 60 to 40 portfolios during any of the market downturns. And 60 to 40 meaning 60% on equity, 40% on fixed income. So for example, during the market crash of last year, the balanced portfolio fell by roughly 23 to 24%, while the pure equity allocation portfolios fell around 43 to 45%. That would be considered as half of your portfolio value. Are you okay with that on the short term? If yes, then you probably should be considering a growth portfolio, which I'm going to be covering in a bit. And if you're not, you'll probably be okay with being in a balanced portfolio and only losing 23%. But if you're not even okay with that, then you need to go back and pick conservative one. Let's take a look what kind of all-in-one ETFs we have for balanced portfolios. And the first one is iShares Core Balanced ETF Portfolio. The ticker symbol is XBAL.TO. This one has a MER of 0.20%, so we're still pretty good there. In terms of the asset allocation, we have US equity at 30%, Canadian equity at 15%, and international equity at around 18%. As you can see, we're already a lot more into equity than we are with conservative portfolios. All in all, we have 65% allocated to equity and 35% allocated to fixed income. This is one of the most popular portfolio types, so that you are still gaining this growth back to your investments, but you're also less risky for all different types of market downturns. Also, always need to consider what the fee you're paying for holding the ETF. That's why the next all-in-one ETF is my favorite for a balanced portfolio. And it's Horizon's Balanced Dry ETF Portfolio. The ticker symbol is HBAL.TO. And the MER is at 0.16%, which is the lowest among all other all-in-one ETFs I'm covering today. In terms of asset allocation, this ETF is a lot into US equity, around 40%. Then it has around 10% in the Canadian equity and around 15% into international equity. What's left? It's around 30% into fixed income. So all in all, this portfolio is balanced around 70% into equity and 30% into fixed income. And if this is something that suits you, you might hold this ETF and only this ETF for your entire portfolio. The other two all-in-one balanced ETFs we have is the Vanguard Balanced ETF Portfolio. The ticker symbol is VBAL.TO. and BMO Balance ETF. The ticker symbol there is ZBAL.TO. So those have MER of 0.25% and 0.20% respectively. In terms of the asset allocation, they're pretty close to each other. they're targeting around 60% into equity and 40% into fixed income. The major difference between those is the MER, right? So the Vanguard has 0.25% and the BMO has 0.20%. So you always want to consider that as well. And the final type of the portfolio we have today is the growth portfolio. This is the most exciting one. This gives you a lot of growth back, but it's also the most risky one. Generally speaking, if you're young, if you have a long career ahead of you, if you don't plan to use your investments for the next 10, 20, 30 years, then this is the way to go. This is the right portfolio for you because you want to get as much as possible from your investments. And some would say that for your growth portfolio, you want to go as crazy as 100% into equity, no fixed income, nothing like that. You want to get just growth. That's it. And I partially agree with that. That's actually what I'm doing right now. I'm all into equity. I don't have any fixed income stocks or ETFs in my portfolio as of today, but I'm certainly going to plan adding those in the next 10 to 15 years. It's probably not the best path to choose, but I also not plan to use my investments for the next 10, 20, 30 years. So I'm trying to gain as much as possible from the growth, and I'll consider or reconsider my goals in the next future so I can rebalance my portfolio back to something more balanced. And there is actually one all-in-one growth ETF that also targets 100% equity, zero fixed income. Let's take a look. We're looking at Horizons Growth Tri ETF Portfolio. The ticker symbol is xgro.to. So this one has a MER of 0.17%, super low MER as all other Horizons products. And from the assets allocation, we're looking at 56% into US equity. That's quite a chunk. Around 15% into Canadian equity and around 15 to 20% into international equity. This one gives you a lot of growth on the long term and also gives you a ton of risks on the short term. Don't sell it for the next 10 to 20 years. There are also 3 other all-in-one growth ETFs that you might consider that have less risky assets allocation, around 80% equity and around 20% into fixed income. And these ones are iShares Core Growth ETF Portfolio. The ticker is xgro.to with a MER of 0.20%. The next one is Vanguard Growth ETF Portfolio. The ticker symbol is vgro.to. This one has a MER of 0.25%. As you can see, there's a trend, right? Where the Vanguard ETFs, even though they're more popular, they've been around for a longer time, they also have a higher MER than the others. And the final one is the BMO Growth ETF. The ticker symbol is xgro.to. This one has a MER of 0.20%. As you can see, there are a ton of products you can use, and depending on your goals and where you are in your life, you can choose the one that fits you. And the best part here is that your investing becomes extremely simple. You just pick one ETF from the list that we talked about today, and you keep contributing to it on a regular basis. That's it. You don't do any rebalancing, you don't care about what the stocks are and all that. That's what you do for 5, 10, 15, 20 years. And then when you are getting closer to the time you start using your investments, you just pick a different types of all-in-one ETF. Say you go from the growth to balance and then to conservative. The closer you get to your investment withdrawal time. So now we know what we have on the market in terms of the all-in-one ETFs per risk level. So now it's easy, you just pick one and keep contributing to it. So now the easy part, decide what your goals are and what your risk level is. My personal plan is to hold 100% in equity, all into stocks, and also hold some crypto just in case that thing is gonna skyrocket for the next at least 10 to 20 years, and then start diversifying into more fixed income later on. So I can benefit from all the growth, from all the dividends, from all the market appreciation for the next at least 10 to 20 years. Thank you for stopping by. I really appreciate you watching my videos and supporting my channel and commenting down below. That helps me a lot. That makes my day all the time and also helps out me to reach out to more people like you to get them also involved with investments. I think this is the most important part in your life, to get your financials together, to make sure your future is secured and that all of us can benefit from this infinite money loop. We're in this together. Like this video, subscribe to my channel. Thank you. See you in my next video. Cheers, bye.